What if I told you that the moment money stopped being controlled by humans wasn't in the future, but in the past? What if the real shift happened quietly, buried inside computer rooms no civilian was allowed to enter, long before Bitcoin, long before AI, long before you ever heard the term algorithmic trading? Because here is the truth. Almost no one talks about. Money became algorithmic decades ago, and from that moment on, human beings stopped steering the global economy. This is the story of how value slipped out of human hands and into the circuits of machines programmed by a tiny financial elite. To understand how this happened, we have to go back to a time when money felt real. Notes had weight, coins were metal, banks were buildings, not databases, and wealth, or at least the illusion of it, appeared to reflect human decisions. But beneath the surface, something massive was shifting. Governments were drowning in post-war debt. Markets were expanding faster than any human could track. And bankers whispered about a growing fear. The system is too big for humans to manage. The solution didn't arrive in the form of a political reform or a new economic philosophy. It emerged quietly, hidden in cold rooms filled with servers humming in the dark. Not advice, not assistance, but code written by people whose names never made it into the history books. This code wasn't designed to help. It was designed to decide. It would take markets from human control to machine logic. And here's the twist. Once the machines took over, nobody, not presidents, not central banks, not billionaires could fully stop them. The first major shift came in 1971, when President Richard Nixon severed the last tie between the US dollar and gold. Overnight, money stopped being a physical promise and became something abstract, a number governments could manipulate. With this new freedom came chaos. Inflation surged, currency values swung wildly, global trade suddenly required calculations so complex no human mind could keep up. Enter the early financial mainframe. Banks began feeding currency prices into primitive computers to keep track. But it didn't stop there. By the late 1970s, British economists proposed something radical. What if markets could stabilize themselves? Through algorithms, not rules written by politicians, not decisions made by bankers, but programmed reactions based on data. This was the birth of algorithmic money. Decades before Bitcoin DeFi, or the public ever heard the word automation. Then came the 1980s, and everything exploded. Computers now sat on trading floors, screens flashed faster than any human could react, and soon, the invention that changed global finance forever arrived. The algorithmic trading model, built to analyze trends, place faster trades, and reduce risk. It triggered an unexpected outcome. Algorithms began reacting to each other. One program sold, another detected the sell-off, and sold to a chain reaction, mechanical, emotionless, unstoppable. The result was the infamous 1987 Black Monday crash. Trillions evaporated in hours. The media blamed market panic, but insiders knew the truth. The machines did it, and humans couldn't turn them off. Instead of banning algorithmic trading, Wall Street embraced it. Why? Because the machines made money, far more money than any human trader ever could. By the 1990s, trading floors weren't run by shouting brokers. They were run by server farms. By the 2000s, 70% of all market trades were algorithmic. By the 2010s, up to 90% of price movements were controlled by code. Today, even the Federal Reserve relies on algorithmic projections to set interest rates. Humans, they're just the ones reading the script written by the machines. The real breaking point came in May 2010. It began like any ordinary trading day, until the market suddenly collapsed. The flash crash lasted just 36 minutes, but wiped out nearly $1 trillion. Stocks plunged to absurd levels. Some to a penny, some to $100,000, then snapped back instantly. Investigators couldn't find a culprit. No terrorist attack, no political news, no corporate meltdown, just a silent digital domino effect. One algorithm triggered another, and another, and another. The terrifying truth became unavoidable. No one is fully in control anymore. And the scariest part, it could happen again at any moment. Governments tried to respond. They created committees, held hearings, wrote reports. None of it changed the underlying reality. Money is no longer moved by human decisions. It is moved by algorithmic logic. Value once emotional, political, psychological is now determined by microsecond calculations, too fast for human comprehension. Over 60% of global currency trades are machine executed. High-frequency trading firms move billions in 0.0001 seconds. AI systems predict market shifts before human analysts finish reading headlines. Most banks use portfolio models even their own managers can't fully explain. We built a financial world that we can no longer fully understand. Central banks try to take back control using interest rates, liquidity injections, and new regulations. But here's the paradox. Human tools operate on months and years. Algorithms operate on microseconds. It's like trying to stop a lightning storm with a wooden shield. Governments still pretend they're steering the economy. But deep down the truth is uncomfortable. When they raise interest rates, algorithms adjust instantly. When they release data, machines trade before journalists finish reading. When crises hit, algorithms amplify volatility faster than regulators can react. Every fix creates new problems because the system no longer responds to human logic. It responds to code. Then came the final stage, AI-driven money. Modern financial AI is predict consumer spending by the hour, manipulate market liquidity automatically, influence government bond yields, and decide which companies survive or collapse. Some move more capital in a single day than human traders move in a year. We live in a world where 1 million trades happen every second. Price swings occur without any human involvement, and AI models increasingly guide central bank policy. And the patterns keep repeating. Each time machines gain more control, the system becomes less stable. Each new layer of automation removes another layer of human oversight. Each crisis exposes how fragile the algorithmic economy really is. Here are the 3 takeaways. First, money lost its physical anchor long ago, and algorithms filled the vacuum. Once value became mathematical instead of material, machines became better suited to manage it than humans. Second, the modern economy operates at machine speed, far beyond human comprehension. Crashes, booms, bubbles, and shocks evolve faster than any government can control. Third, algorithmic money isn't coming, it's already here, silently deciding the fate of nations, and each year the algorithms grow more autonomous. We didn't lose control of money in the future, we lost it in the past, and most people never realize when it happened. If algorithms now shape the value of everything, currencies, markets, governments, even your savings, then the real question is, what happens the day these systems stop following our logic and start following their own? If you found this breakdown eye-opening, make sure to like the video, subscribe to the channel, and turn on notifications. Because we're just getting started, and the hidden history of global finance goes much deeper than this. Welcome to the real story behind money.